Good morning, and wishing you a great Tuesday ahead. Welcome to today's episode. We're talking about three things today. 95% of S&P 500 up, some Fed speak, and Nikkei down 3.3%. US stocks rallied Monday, lifting the Dow by more than 550 points as shares of everything from banks to manufacturers climbed. Monday's moves marked a comeback for stocks after investors' anxiety about the Federal Reserve's path of monetary policy sent the Dow to its biggest decline since late October on Friday. Initial worries centered around Fed officials signaling they may raise interest rates sooner than anticipated due to the rebounding economy. Investors who are optimistic about stocks say that faster growth and inflation in the coming months are likely to support the market overall, even if long-term rates rise slightly. The Dow was up 1.8%, the S&P was up 1.4%, and the Nasdaq was up 0.8%. Stocks rose broadly on Monday. All 11 sectors of the S&P 500 finished higher. Energy was up 4.29%. Financials, industrials, materials were all up more than 2%. Technology was up about 1%. The S&P 500 index's 1.4% gain on Monday came with 95% of the equity benchmark members advancing, the third time above the 90% threshold this year and the largest share since April 8th of 2020. Back then, stocks were emerging from the pandemic rout and the index closed up about 3.4% on that day. So very broad breadth that we saw in the market yesterday. Part of the market's rebound on Monday was the revived reflation trade, at least to some degree. Value stocks, which are more sensitive to inflation and economic growth, are outperforming the market. The Russell 2000 was 2.1% higher. The price of WTI crude oil also rose about 2.7% to just about $73 a barrel. That sent the energy sector up about 4.3%. The yield on the 10-year US Treasury note climbed to about 1.48 from 1.44 on Friday. The 10-year yield has dropped for 5 consecutive weeks through Friday, its longest stretch of losses since August 2019. Bank stocks were also having a strong day, powered by the rising long-dated bond yields and falling short-dated yields. The SPDR Bank ETF gained about 3.6% as the 10-year Treasury yield rose to 1.49 from 1.45, while the 2-year yield was down a tick. Banks borrow short-term money to lend for the long term, so the dynamic seen in the bond market yesterday increases profitability for banks. On to Fed speak. We'll be tracking this more closely over the next couple of days as the market also tries to make sense of how to look at inflation and growth. Two officials echoed calls for price vigilance coming from various corners. Robert Kaplan favors starting the tapering process sooner rather than later, while James Bullard called it appropriate that the FOMC kicked off the debate last week and suggested starting with reducing MBS purchases. We have to be ready for the idea that there is upside risk to inflation and for it to go higher, is what Bullard said. John Williams went against the grain, predicting inflation will come down from around 3% this year to close to 2% in 2022 and 2023, while admitting a great deal of uncertainty. Jerome Powell, who's meeting with Joe Biden for the first time Monday, reiterated in remarks released ahead of Tuesday's congressional testimony that he expects price spikes to drop back as supply constraints abate. On to some corporate developments. Shares of London mining giants Rio Tinto and BNP and Glencore, all of which are major producers of iron or copper, were lower. Rio Tinto stock was further weighed down by a downgrade by Swiss bank UBS, which changed its rating on the stock to sell from neutral, noting risks from a more hawkish Fed and China taking actions to deflate commodity prices. Shares of Morrisons, one of UK's largest supermarket group and e-commerce giant Amazon's grocery delivery partner in the country, jumped about 32%. Analysts expect the company to attract more takeover bids after rejecting a $8.7 billion offer from a US private equity firm. Yesterday, we saw big moves in the Japanese market. The Nikkei dropped over 1,100 points or 4% at one point to its lowest level since May 17th before closing the day down 3.3%. The benchmark recorded the biggest percentage drop in nearly 4 months, with shares in 96% of the index's 225 companies trading lower. The broader Topics index closed down about 2.4%, while the startup-heavy Mothers market fell about 1.8%. Japan's market sell-off was worse than in other Asian markets. The Hong Kong's Hang Seng was down 1% on Monday, while South Korea's and Taiwan's benchmark was down about 1.2%. China's Shanghai Composite Index was flat. Australia's index was trading 2% lower. All of this was reaction to what happened on Friday in the US, but Japan's market decline was a little more pronounced. A point to note, Japan's stock market with many cyclical stocks was a beneficiary of the reflation trade that was placed in the market when we had better growth prospects and rising inflation prospects as well after the COVID-19 vaccine developments. In February, the Nikkei touched its highest level in more than 30 years. Some analyst comments that I'm reading out. Japan's stock market is declining the most as it has the most liquidity in Asia. Today is somewhat of an overreaction. I think the sharp decline won't last long is what some of the comments are. Uniqlo, owner of fast retailing, dropped more than 4%. SoftBank Group ended down 3.5%, hitting its lowest level since December. Some investors are concerned that an earlier rate rise could hinder the US economic's recovery from the pandemic. As a result, shares in Japanese exporters set to benefit from rebounding economic growth like auto companies and chemical firms also fell sharply. Shares of Suzuki Motor dropped about 4.6%. Semiconductor related companies also took a hit. Tokyo Electron was down more than 3%. That is the update. Stay safe and healthy, and I'll speak to you tomorrow.